Hi, I'm Erin Nielson. I'm a family law attorney with Wilshins, Cosentino, and Nobbins in Wellesley, Massachusetts. And I'm here today with Don Ludwig from American National Insurance. And I asked Don to talk to me today because many of the people that I work with are subject to orders from the court to maintain life insurance policies to secure either their child support or their alimony obligations. And so I had some questions for Don that I thought might be helpful to more people out there. So thanks, Don, for being here.
Thanks for having me.
So my first question is just a general question about what type of life insurance policies are available out there for people to choose from.
Yeah, there's really comes down to really two basic types, and it's much like buying, getting a car. You can either lease it or rent it for a period of time, or you can buy it and own it, and it becomes an asset of yours. So in the life insurance world, there's term insurance, which is temporary insurance, which is what you basically are renting a certain amount of coverage for a certain period of time. And then there's permanent or whole life or universal life insurance, which is a permanent product, meaning it doesn't expire. You're not buying it for a certain length of time, and it's there generally when you need it.
Okay. And a lot of times I see people sort of relying on life insurance that they might be offered as a benefit of their employment. Can you explain what that's all about and if there are any downsides to relying on that?
Yeah, we see that a lot as well. And that's a benefit. So the way those work is they are temporary insurance policies that the company gets based on the aggregate of all of the employees who opt in to get that benefit. So the premiums on those tend to be attractive, and they're usually a payroll deduction, so people don't even notice, that they're paying for it. But that's because it's the law of large numbers. It's based on, the average age and then spread out, over all of those people. And so the coverage, while a nice benefit, it's not what I would consider an asset or anything that you can take with you. So if you were unfortunately to lose your job or leave to go to a different company, you can't take that with you. So while it's a nice benefit to have, it doesn't create that asset that actually, is there to do what you probably intended to do. In this specific case, have life insurance in place that is in place for a period of time that you've either been, court mandated to or have chosen to do. And
Yeah. So thinking about the potential to sort of unexpectedly lose your life insurance policy if you lose your job, what are things that might make it difficult for a person to get life insurance on their own?
Yeah, and it's the way I like to think about life insurance and have people look at it is look at it as an asset, just like an investment or any other asset that you own. And the way life insurance is priced in the market is dependent upon two things. One is obviously your age. The closer you are in that bell curve to mortality, obviously the more expensive it gets. And then the second aspect to it is your health. So two things that are very important in driving the way insurers price life insurance. One of them you can control, one of them you can't control. In a sense, you can't really control your age. We all go, Father Time gets us all in the end, but you can choose when you buy it, and the sooner you buy it at the youngest age, the less expensive it's going to be. So the sooner you can lock that in, the better price that asset will be for you. Health we can't control, and that's one of the downsides of looking at either a temporary product or looking to the workplace benefit life insurance product to be your solution. Because like I said, if you leave, or if that term is up on the rental insurance that you bought, and now you haven't been able to control what happens to you health wise, you do have a problem that makes you uninsurable, or you are insurable, but it's going to cost you a lot more money because of that, new condition that you have. So that's why, the sooner you can lock it in from an age perspective and a health perspective, the better price that is going to be for you in the long run.
Is price sort of the major driving point for decisions that people should be using, or is there some other factor?
It shouldn't be. I mean, obviously, like any other, purchase decision, it's a factor. I think people need to think more about, what it does for you. Life insurance is not for the person whose life is covered. It's for those things that are left behind. So family members, replacing lost income, paying off debts and obligations, mortgages, providing money for education for children, providing a legacy for the family so that the lifestyle doesn't have to change because of the death of one of the main family members. So it really serves a lot of purposes, and it's not just a price decision. It's you really have to understand what is the what if something happens, and how do I solve that problem? And there's no product that's better suited to solve that problem than life insurance. So.
Right. And so just in general, can you describe kind of the difference between a term life insurance policy and a whole life insurance policy, and why someone might choose one over the other?
Yeah, absolutely. So a term policy generally is used for a short-term need, and it's as I alluded to, it's kind of like renting the insurance. You pick two variables. You pick how much insurance you want to have, and then you pick how long you want to have it covered for. So generally they come in 10, 15, 20, or 30-year terms. And again, unless you die within that term, in that period, that policy will never pay a death benefit. If you happen to die within that term, then it will pay it out. The policy doesn't generate any dividends or interest inside of it, so it's not really an asset. It's really an insurance product that's insuring against something catastrophic happening. The other type is permanent insurance, and the attractive part of that is that it does not run out. So the term is not an issue. So it's going to be there when you actually need it. You do get to pick the amount on how much you need, and that generally is driven by again the desires and the needs. Usually, what I do with families is I look at it. We use the acronym DIME, D-I-M-E, so debts, income, mortgage, and education. So if you think about those things, those are generally the key drivers that people want to have satisfied, through a death benefit. So look at those. Look at what's an appropriate amount and a number. The real thing I think a lot of people miss with a permanent insurance product is the fact that there is a cash value to it. So there's a cash accumulation value inside of it that is available to you as a living benefit. And one of the things we like to say is it really satisfies any of the life instances that could potentially happen to you. If you die too soon, there's a tax-free death benefit that is paid out to your beneficiary. If you live too long, there's a cash accumulation inside of it that you could tap into to actually supplement your retirement. So you could have it actually pay you a monthly check that will supplement your retirement. And again, tax-free. And then the last thing, which is, raised a lot of people's eyebrows, is the need for money during a medical event. So a long-term care type event. Long-term care policies were very popular back in the 90s and the early 2000s, but the cost of providing long-term care has far exceeded the amount the insurers can afford to put a product out for and have people buy. So most of the carriers have pulled out of that market, and the ones that are left really are providing a product that is providing a pool of money that you can tap into. And many times that pool of money is not large enough to take care of a long-term care need. So the nice thing about life insurance policies today is that they have living or accelerated benefits, which allow you to either get a partial or a full access to that death benefit while you are alive if you have certain triggers for a chronic, critically or terminally ill client. So there's an ability there to be able to tap into that money to help pay for medical services. And again, it's tax-free.
So for those people who have to obtain life insurance because of a court order, this is kind of a nice way for them to sort of hedge their bets and get a benefit back from the money that they have been compelled to pay in by the court order.
Yeah, it is. And the natural instinct is to, go the cheapest route and just satisfy that requirement. But I think if people step back and think about it and, you're obligated to have this. So why not make it into an asset that actually works for you? So if you were to go for a permanent insurance product that had that cash value associated to it, you not only satisfied the divorce decree, you took care of the kids if there was an incident, which is what it's there for. But once that time period is up, you still have that money accumulating in there that you can use for new family issues or new requirements. You may have been remarried and now have other children. It's still there to take care of any debts that you have, still there for providing a legacy for either your family or for a charity, a college, or whatever you want to leave a legacy to. And again, more importantly, it's there for the two big things today, and that's if you have a long-term care event or if you outlive your retirement savings, you have another ability to provide yourself with some income during retirement.
Wow. And can you tell me again, what is that type of policy called?
It's a permanent insurance product. It's either called a whole life. There's a lot of trade names for it, but in its core, it's a whole life insurance product. Sometimes called a universal life policy as well. And the universal part of it just means that it's a little more flexibility to the product. You have a little more flexibility around premium payments and how long the product runs for. But really, it's as I said at the outset, there's renting and there's buying, and this is the buying part that we're talking about, the permanent product.
Right. And I think you said that it's not something that all carriers are offering anymore. Is that right?
The long-term care insurance policy itself, at one point in time, there was a policy that just addressed long-term care that you could buy. But what happened is the premiums on those got so large that people couldn't afford to buy them. And at the end of the day, the costs of either in-home or in-facility care just increased so large that they couldn't provide a big enough pool of money to actually make it a worthwhile product. You could pay if you had the money, but you still couldn't get enough money to actually cover a year or two's worth of nursing home care, which, if you look at what that costs today in Massachusetts, it's pretty staggering.
So now it's still offered as kind of part of this hybrid product?
Yeah, so what the life insurance companies did is recognizing that need, they just provide a rider, and it's some companies call it a long-term care rider. I sell American National's life insurance product, and we call it an accelerated benefits rider. And it's a no-charge rider that we put on all of our policies that have different trigger points on whether you're chronically, critically, or terminally ill. And depending on which one of those, you have access to an actuarial derived percentage of that death benefit. But, hypothetically, if you had $1 million life insurance policy or a $500,000 life insurance policy, you have access to that, fairly close to that dollar amount that you can pull out to cover an event like that. So and again, it's tax free. So it's a nice way of solving, like I said, anything life throws at you. You die too soon, it's there. It pays your beneficiaries tax-free. You have a health issue and you need money for long-term care, it's there and it's available tax-free. You live too long and you don't have enough retirement savings, you tap into it and it's there to provide an income source tax-free. So it's a great asset or a great benefit to have going forward. And so, I would encourage people going through a divorce to think about not going the easy way, which is to just rent a policy for the time period that you're decreed to, and think about creating an asset that works for you, now and for the rest of your life.
I think you talked a little bit about the things that people should consider needing coverage for, but is there any sort of a magic formula that people should have in mind about how much coverage they might need based on the
I think
family
if
size?
the back of the napkin, coffee cup kind of discussion always comes back to, and I think it's the simplest way to think about it, and that's that dime principle. So your debts, what debt level do you have that you want paid off so you're not leaving that to the people behind? What level of income is lost when the person dies, and how long and how much of that income do you want to be provided for, so that people don't have to make quick decisions, sell off assets, at reduced rates in order to just survive. You want the people left behind to at least maintain their standard of living that you've, been living under for a period of time, and let them transition properly. Mortgage, you always want to think about paying the mortgage off. That's generally the largest debt most people have. So making sure that's paid off, and no one's left having to deal and worry about that. And then education. So it's important for some people to pay for their kids' education, or at least provide some funding for it. And if that is important to you, then you want to factor that in the equation. You wouldn't want to die knowing that you had intended to pay for your child's education, but now because you've died, there's no longer any money there to provide for that. And it's just peace of mind knowing that even if you did die, that money is there and it's earmarked to go towards that. So that's the principle that I go under. The dime principle tends to work, and I think it works for everyone. And you don't have needs in each one of those areas, but if you do, that's a good way to think about it.
Thank you. That was so helpful. You've taken something that is kind of complicated and sometimes not very pleasant to think about, and made it really straightforward. So I appreciate it.
Yeah, no, thank you. I think, encouraging clients to just think outside the box a little bit, and not just take that short way out, I think, and think about it from a longer term perspective, and the benefits that it provides. I think, it's a win-win. So.
Yeah, it really is. Thanks, Don.
All right, Erin, thank you.
Take care.